Good evening, folks. I'm Lee, the Pit Village Trader. Now, I'm in the process of writing a blog post about how I made £25,101 spread betting the markets in 2018. And in step number 3 of how I did that, we're talking about risk-reward ratio, and risk management principles. And I was writing away and I was typing, and I honestly think I was boring myself with writing this article because it just I thought, you know what, let's just crack on a video, make a video, and then it will help people understand what it is, what the concept that I'm trying to teach in this article, and hopefully that will be a good accompaniment to the actual article that we're making. So without further ado, let's have a look at our account. Okay, we're talking about risk management, and we're basing our conversation of risk management on a starting account of £500. We are talking about risking no more than 10% of your total account capital on each trading position that you open. Now, that means for each trade that you open, you don't risk more than £50 per trade. And the way you do that is by setting an appropriate stop loss level in your trade so that if the share price moves against you and it hits that stop loss, then the position is closed out and you take your £50 loss. So the example that we're talking about is a £500 account, 10% risk, £50 per trade, and the other element of how to calculate your correct risk reward ratio and how you should correctly manage your risk profile and is how often do you win or get lucky with your trades enough to turn a profit. So in the article I talk about £500, 10% per trade. We're using simple maths here. That equals 10 trades at £50 per trade. If you lose 6 of them, assuming that most people will lose more than they win, then that means you will win 4 of them, or you'll make a profit on 4 of them. And how that will have to happen is that if you lose £50, you're going to lose £300. To recover that money and keep your account in a profitable position, your 4 winning trades will need to win at least one, will need to profit at least £100 per trade. So that's a profit of £100. That means you profit the £100 and get your original starting capital of £50 back. So 4 times £150 would give you £600, which would be a 20% profit on your total account balance. That's the principle. Now let's have a look at an example. How does that work in practice? Well, at that kind of level where you've only got £50 to risk per trade, you really don't want to be trading in market sizes that are, if you want to cover in a stop loss about 10%. So if you want to make sure that your stop loss can withstand a 10% fluctuation in price, which is a good guideline, then you can only trade really in those marketplaces that you can afford. So let's just have a look. I'm going to go to the FTSE mid 250. This setup that I'm using here is IG Index. IG Index is spread betting platform. And okay, so let's have a look. So let's have a look at, so what's 10% of Sports Direct? Yeah, okay, so 23. So let's go for Sports Direct, right? So let's have a look. Sports Direct. We'll go back to 2019. So in 2019, this share price is pretty much traded within a range, although we have had a very big decline recently. So I would be tempted, if I was opening this position, to be short in this position. I don't trade reversals, as I've said many times before. I am not tempted at all in this position to think, oh, this is a sudden drop, it's suddenly going to turn around and turn a profit. I don't believe that that's going to happen with this share. So I would be looking to sell this share, this stock. Okay, I'd be looking to short it based on the weakness that I can see in this position. Now, I've only got £50 to risk on this trade, and I want to be 10%. I want to give myself 10% stop. So that means my stop can be around 23 points. So that's 20, let's just say 24 points, okay? So 24 points. That will allow me to place a trade, a trade size of £2 per point, which means for every point the share price falls, we will make £2. Now, we talked about risk and reward. If we think we're going to lose 6 of our trades and lose £300, we need to make £100 profit, or 2 times the amount we're losing, we're risking per trade on each of our winning trades to make sure that our overall account size returns a profit. So what that means in practice is that our target, you see, when I adjust this limit amount, you see the pop-up that's appeared there, risk reward ratio, we need that to be at least 2 to 1. Sorry, 1 to 2, going the other way around, basically, because we need to risk £50 and make sure we win 100. So we would, if we would open this position, we would need to hold this share until it fell to this price. We would need to do that on 4 of our winning trades, or have one trade that just goes further and further than you think, or open additional positions in trades that are going your way. So if we see this stock turning in our direction, we might be tempted to add to our position and use that as a second trade. So you've got £50 in your first trade, £50 in your second trade, but now we're profiting £4 per point as that price drops. That's always a good idea to add to winning positions. And when you feel that everything, all the reasons why you got into that stock in the beginning are still present. So that's basically what we need to do. So we need to make sure that we have our risk reward, risk 1, reward 2, if you think you're going to lose 6 and win 4. Now, the downside of all of this is that you will only know what your win-loss ratio is after you've traded for a certain amount of time. So how you could do that is you could open a demo account on any of the spread betting accounts, any of the spread betting providers that are listed on my website. If you go to pitvillagetrader.co.uk and then click on the option at the top for learn to spread bet, and then go down to spread betting companies, and then you will see there's a review there for all the spread betting companies giving you the costs associated and whether you can open a demo account, how long the demo account is open for, etc, etc, etc. Gives you all the details. You can click on any of those accounts, open a demo account, give yourself a little kind of paper exercise, a demo account, trade for 3, 4, 5 months, maybe half a year, 6 months, measure your results. How many are you winning? How many are you losing? Try and crystallize that or consolidate that into a figure, like an average figure. What's your average win? What's your average losses? And then from that, you can use that information to then move into the real account trading, and you will have an understanding of the risk profile that you can play with in your trades. And that's it. That's what I wanted to explain in a much better way than I can on in my little words and my writing. But I hope that's useful, guys. And if it is, please drop me a comment below. If it's not useful, also drop me a comment below. You know, let's make this a two-way thing. I can help you, or I can only help you if you get in touch with me and if you let me know what's going on. Have a great night. Have an amazing time with your family if you have one. Spend time with your friends if you've got them. Be happy and trade well. See you next time. Cheers. Bye.